How's everybody today? It's great to have you back again. Let me see what's wrong with this thing. Let's go there for a second. All right. It's good to see everybody. Great to have you. It's a nice Tuesday morning. We're going to look at the Top 100 Club. Now, what does the 100 Club mean? Well, of course, that means that these stocks have all, in the past year, 2024, they broke 100% increase in value. So that's a pretty good stock. Anything that'll go 100%. So we figure that the name of the game is, we know past performance is not necessarily indicative of future results, but if it made 100% last year, it's probably a pretty good stock, and people probably continue to buy it going into this year. And so that's the theory. And so that theory so far has been holding true to some degree. This 100% club, we're now moving on to almost halfway through the year. Can you believe that? June is the 6th month out of 12. So we're almost halfway done with this year already, and already looking forward to the fall classes at the university. They've sent me a notification and said, Lan, can you bring us up to speed on what you plan on teaching, what your curriculum's going to be, so that we can get that out to the people? And of course, we're going to be teaching stocks and futures and day trading and UBI, universal basic income. We're going to be teaching all kinds of fun things at the university. So if you're in the local area, St. George, Southern Utah, or if you want to fly in, you can do that. We have people do that all the time. Well, I wouldn't say all the time. We've had a few people do that, where they fly in and stay at an Airbnb for a couple of weeks and take my classes. That's a fun thing to do. You can do it. And if you have a business or any sort of a write-off capabilities, you can write it off on your taxes as education. All right. So we'd love to have you at the university if you want to come and join us. And those are live. They're not broadcasts. I don't broadcast those. Why don't you put those on, Lan? People ask me all the time, how come you don't record those? Or why don't you broadcast those live? Put a camera in the back of the room and record those. Well, I'll tell you why. Because back when I was at the Board of Trade and we used to travel all over the place, there was no such thing as that ability. We didn't have that capability, right? We couldn't do it. And then it came out and it started to get a thing. You could do it. And we could put these, and so we tried, believe it or not, we tried, and we would spend more time dinking around with the stupid camera equipment and the sound equipment and somebody running back to the back of the room. And then, and then somebody in class asks a question and, the people online can't hear what the question was. And then, Lan didn't repeat the question well enough so the people online could hear it. It just got to be one big cluster boondoggle. And it was a nightmare. And so I'm like, you know what? If people pay the money, they spend the time, they get in their car, they drive down to somewhere and come to a live presentation, why would I sit there and dink around and try and accommodate somebody who was lazy and decided to stay home and do it that way? Well, somebody across the world. Well, they can watch a recording of me on YouTube then. But if somebody comes to a live presentation, they're not going to see me sitting around dinking around with audio equipment for somebody who's not there in person. So that's why I did it. I just don't bother with it. People come live, then we work out live, and that's the way it is. So those people who are there, they appreciate that. They appreciate that a lot. So, but today we are not live. Well, we are live. We're live. This is live, but we're not in person. So that's okay too. We're having fun. And there's different mediums for different people and for different times and for different strokes for different folks. And that's the way it goes. So on YouTube, everybody's welcome to come to the lab of my university classes. Now, this is the summer session. We're in summer school. And so we have a shorter term class presentation. We're going to only be teaching the labs on Tuesdays, Wednesdays, and Thursdays. All right. It's summer and school teachers like to take that off, right? But I'm not taking it off completely. I work my tiny off for you guys all the time, coming out with great new things for you so you can have all kinds of fun research, all kinds of fun tools, and all kinds of fun things under the banner of Pitt News Magazine. So if you guys would like to join us and be a part of the club, then pick up Pitt News Magazine. It's not very expensive. It's $39 a year. And then that gets you all the magazines, and all the magazines are recorded, so they have audio on them. All kinds of neat stuff. Here, in fact, I'll let you. I got a little thing for you. Watch this.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out risk-free. Satisfaction guaranteed or your money back. Visit pitnews.com. That's pitnews.com. Pitt News Magazine. News your way.
All right, Claire got me a new ad, not quite as long as the last one. So for you guys who come on a regular basis, you don't have to sit through a big long 2-minute ad. Excuse me. Hold on. Let me take a drink of water. That's when I always screw up and forget to turn off the mic, turn the microphone back on, go take a drink of water, but it's on. I turned it back on. Also, look at this guy here. Those of you who know this
Look,
guy.
if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
We would never use AI, never, to get celebrity endorsements for our magazine. All right. So got that out of the way. And we want you all to join us. And I actually, now, okay, I'm going to make a caveat here because many of you already have Pitt News Magazine. And that's the point, right? We're here, or a club, or membership, and you have Pitt News Magazine. And one of the advantages of having Pitt News Magazine is that I post and I have these spreadsheets that I use for my own personal use. And so I then try to create versions of them for you guys so you can have them as well. So you can have these big spreadsheets that I use to track my trades. And I posted a new spreadsheet with this new issue of Pitt News Magazine. So the new issue of Pitt News Magazine came out yesterday, was posted, and I sent out an email. And if you didn't get that email, go see it. We've been experimenting with sending out different kinds of emails because a lot of people don't get our emails. Throws them into the trash, or if you have Google, it throws it into some other. Google has like 4 inboxes, right? So it throws it into, like a promotional inbox or something, and it doesn't come into your main inbox. So you have to look around when it comes to the first part of the month to find out where that email went. But anyway, it gave you a link to the new email, to the new magazine. If you haven't got it, go look for it. If you haven't, send me an email, lhturner@geckosoftware.com or lhturner@pittnews.com. Either one of those works. And you can let me know that you didn't get the email, and I will send it to you again. But go look. It should be there. And in the email, there's a link at the bottom to the spreadsheets. And I promised I would send out my new spreadsheet. And I did. But there's errors in it. All right. I'm going to tell you right now. You got it, but it's not perfect. It's got problems. And I'm going to bring it up right now very quickly here. And I'm going to show you where the problems are so you can be aware of them. And I don't know if you're going to want to actually start transposing and putting all of your stuff into the new spreadsheet right now or not, if that's, because I probably send out some updates to it next month when I can get better updates. But this is the new spreadsheet. And as you can see, I've made it a little bit different, changed it around a little bit, quite a bit, actually. A lot of different math formulas, a lot of different views, different look. But this is our UBI, Universal Basic Income spreadsheet. And so we track things a little bit differently. We've got in here, and yours doesn't have some of the stuff that you see even here. And that's how I know yours has a mistake in it. All right, because I started to try and I tried to figure out cash on hand. And I can't figure out cash on hand. And I can't figure out how, if I want to take cash out of here and reinvest it back down in here, how to make that come out of cash on hand automatically. We can do it manually, but that's no fun. You got a spreadsheet. You want the spreadsheet to do it automatically. The problem is it doesn't know if I put it in here and it becomes, there's some caveats. I may have to just say, well, you have to do it manually because it doesn't know if it's new initial depository you took from working at McDonald's, or if it's money that came back and circled back around and came back in as an investment from earnings, dividends, that type of stuff. And that's where the hang up is. And I'm trying to figure out, ChatGPT and I are working like good buddies and pals on this problem for ourselves. We're trying to figure out if we can't figure out a way to make that happen automatically. So we've got we got UBI received, we got total infusion, we got total dividends, we got initial deposits. We broke all this stuff out, current value, all kinds of neat stuff in here to try and figure out if we can't, automate it, make it automatic. Now, on my real money one, I haven't got some of that features in there because it's real money and I just pull up my real money account and type in the stuff that I need. This one, it's a model. So I thought, well, it might be fun if we can't make it do it automatically. Anyway, you guys have this spreadsheet now. It's available to you. You can go download it. And nobody knows that I posted it unless you come here to class, and then I tell you. So usually there's a link to the spreadsheets, but the spreadsheets have been the older spreadsheets. I finally updated it and got you that new one. So there you go. And that's, in my opinion, my time is not free. And I've spent literally months and months working on these spreadsheets, and I give them to you for free. Well, because you're a member of Pitt News Magazine. Because you subscribe to Pitt News Magazine, you get hundreds of hours of work on those spreadsheets for you to have for yourself. All right. And that's just a little bonus for being a part of the club. And that's okay. I'm not trying to sell things and make money off of you, just trying to survive, keep my staff going. All right. I got plenty of money myself. I don't need yours. So, but we do ask you to help us pay for Claire's time and Aiden's time and Jordan's time and some of these other guys that are working here. All right. So I appreciate that. And also, let's come in here and say hello to a few people. It's nice to see you guys popping in here and saying hello this morning. We got John. I can see John out there, and I can see Albert and Bruce. Nice to see you, Bruce. I already got the Pitt News Magazine June issue. They're great. Glad to hear it, Bruce. That's a better endorsement than Bill Gates saying that he got it. I'd rather have Bruce say he got it. It's a much better endorsement. Thank you, Bruce. Chad, good morning. It's nice to see you. We got Kurt out there. Chad says, hey, Lan, Claire is a real person. They're all real people. All right. So I love my Pitt News Magazine. Randy, great to see you. Great to have you. All right. Pitt News arrives correctly in my box. Wonderful. That's good to hear. If it doesn't, if it's going into one of those other boxes, if you got Gmail and they got 4 inboxes, just drag it in, just drag it over to the one you want it into. And that tells Gmail that, hey, this is something important to me. And it'll try and put it over there. It'll start putting it over there in that normal box. And then also take our email address and put it into your contact list. And then they'll definitely put it in your first box. So that's what we say when we say whitelist us. That just means take your email and put it into your contact list. So that then that's whitelisted, meaning they'll now put it into your main inbox. All right. One more time. I'm going to take one more drink of water, and then we're going to start looking at the 100 list. Yes, Chad, they're all real people, but we have changed the names of many people for purposes of unknown reasons. Claire might not be her real name. How's that? All right, let's move through this. All right, let's get started. The first thing I want to do is I want to just pull up the first one in the list. The first one in the list here that popped up is GE Vernova. Now, this is a spinoff from General Electric, and they spun it off a couple years ago. And man, this thing, I just removed all of the drawings because I want to just look at this market and just marvel at this market. Unbelievable. Just a crazy market, isn't it? Look at that thing. This is one of the 100 percenters. This thing just took off like a rocket ship. Now, most of the 100 percenters did, which is kind of those of you who haven't been trading 100 percenters, kind of a good thing for you to know that kind of thing works. Let's bring this a little bit bigger right now. So we'll come in here. How do we make that bigger? Put me down here. There we go. All right, so that's what we're looking at. Look at this market. And I have these little blue lights that come up underneath there. And we're waiting for it to break the blue light. Now, we're going to go through and do a little counts and measures. All right, so we have to count, measure, set up, trigger, and follow through. That's your trading strategy. Count, measure, set up, trigger, and follow through. 5 steps. All right, 5 steps to a successful trade. Land's book. It's an old book. Haven't got it published out there anywhere. I think I'd give it away for free for now. Actually, I think it's part of this book. I think it's part of what book is that? Lan, are you talking about? I don't know. It's part of my book that's on Amazon. Go search Lan H. Turner. There's a book out there on me. I don't have little assets up here today that show my little book. Anyway, you can go get my book out on Amazon, Lan H. Turner, and it has all those 5 steps in it: count, measure, set up, trigger, and follow through. That's what that book is. All right. So what is it that we're counting? Well, we got to count the waves of the market, because markets have a structure to them. Now, it's a loose structure, but it's a structure nonetheless. And the reason it's loose is because lots of people are fighting over the market, right? The market is a tug of war. It's lots of people fighting over the market. So you have these big quant systems, these big computerized systems, and they run things through their mathematical models, and they try to make the market be as systematic as they possibly can, but they're always constantly fighting retail traders, news hounds, those types of traders, and then other big firms. All right. So they're all fighting. It's all one great big tug of war. But what's happening lately, and I've written some articles about this in Pitt News Magazine, and I've noticed this happening over time. I've been doing this for 35, 40 years or something. And the markets have started to become more and more and more systematic and more predictable. Not really predictable, I guess, but more predictable. I mean, that's really what we're looking at, right? We want to try and predict the market. And so the whole idea of being able to predict the market is the guy that predicts it the best is the biggest winner, right? So being able to predict where the markets are going to rise or fall. Now, there's lots of different methods and means of doing that. You can go out and listen to the news. And those of you who are Pitt News Magazine aficionados and have read my articles, you know that I'm not a real big fan of the news. That's the fundamental nature of the market, and it's usually late. By the time you get that information, it's too late. News that everybody knows isn't worth knowing. All right. So by the time we get the news has already happened. It's over with. Everybody who creates the news, they know the news before you get it. And generally, us small retail traders, that's us. So the news isn't really a lot of help to us. All right. Now, there are some news events that will be a little bit more helpful than others. News events like, I don't know, how many cows are on feed and that kind of stuff, some stuff that you might be able to get from government agencies that are not supposed to sneak their information out, but do anyway. Everybody knows that it's not a secret. It's only a secret because you and I haven't heard it yet. So we think it's a secret. And they have release dates. And we look at that sometimes. We watch those dates, more of those are, it's fun to see. It's fun to watch, but really the markets, that stuff's already all baked into the price. Because the only people who don't know about what's going to be in those news events are you and me, little dinky retail traders at the end of the line. So those things are already all built in, but it's fun for us to watch and we like it. And it's not for us to determine whether it's going to make the market go up or down. It's just, the market generally moves a little bit around those time frames. So you do a little day trading around them. Sometimes it'll turn the market a little bit on a fundamental basis. So we'll watch those events, but just, general news is already baked into the market. And that's what we call technical analysis. All right. Technical analysis is the analysis of price. And so what we do is we watch the price. And there's different things that we're trying to model around the price. And it's like, well, Lane, you sit here with these stupid little A's and B's and C's and call these little trends and this stuff. I think that's just voodoo science. That's just ridiculous stuff. Why would you ever do that kind of stuff? That's just the most ridiculous thing I ever seen. Everything's based on fundamentals. Well, the reason this little technical analysis stuff that we call it, the reason it works is because, and it works more now better than it ever has. And the reason is because the quant systems, all right, more and more and more and more companies, more and more firms, more and more giant organizations that manage money are starting to do it with computers. And it's been doing this for a while. I mean, it's not like it's brand new that, hey, guess what? We got computers. How long have we had computers? Right. And so the very first guy that got a computer, he pulled out his TRS-80 and he said, oh man, I bet you I could make this thing trade the stock market. So that's how long we've had computers trying to trade the stock market, since your very first TRS-80, right? So this is the whole name of the game that we're doing now. Nowadays, what we're trying to do is we're trying to reverse engineer the quant systems, all right? Because you and I, we still need to trade kind of the old manual way. We click mouse buttons and we do that kind of stuff. Big firms don't do that anymore. That's not been done for years and years and years by big firms, right? You can't imagine BlackRock in there managing $13 trillion. And then there's some guy sitting there on a laptop with 3 computer monitors going click, click, click. That's not how it works. And anybody who thinks it does is just, they're drunk. So they just lack of knowledge. It's okay. You can't expect everybody to have taken lands classes. And so what we do is we come in here, and what we want to do is we want to kind of try and reverse engineer what those big quant systems are doing. Because if we can reverse engineer them, we have a little bit better idea of what we can do for ourselves. Now, these big guys, they're not any kind of superheroes. All right. They have to do the same thing that we do. They buy low, sell high. And that's how you make money in the stock market. So when these guys write their quant systems, it's not like they have some secret that nobody knows. Now they call them black boxes, and they'll oftentimes you can go out and you can buy black box systems. You can go buy a computer programmer will write something and he'll say, hey, this is the greatest thing since sliced bread, and you need to buy it from me so that you can be rich, rich, rich. You see it on Amazon, or you see it on YouTube or Facebook. You see it all the time. Oh, buy this and you'll be rich. Or, especially on YouTubers out there. I'll just teach you how to be the greatest trader in the world. All you have to do is buy my secret black box system. And then what you find out is black box systems are usually just some sort of a moving average trigger. That's all they are. It's like, oh, when it breaks above the 50-period moving average, just give them an arrow and tell them that that's a secret system, and then put it behind a black box so they don't know what we're doing. That's what they're doing. The reason they black box it is because if you knew what was in there, you'd say, that's stupid. Why would I ever buy and pay you money for that? Well, it becomes a systematic process. And so oftentimes people have a better result with a systematic process than they can by themselves. So we want to be as systematic about our process as possible, but we don't want to be to the point where we rely 100% on a system. All right. Where systems fail, methods prevail. I want you to remember that. Where systems fail, methods prevail. All right. Now, it's not that we're not trying to be systematic. We are. We want to be very systematic about our trading. We have rules that we want to follow. Now, that's the hard part about being a trader nowadays, is that following the rules. All right. A rule-based system is going to be a better trading system than just, willy-nilly coming in here and saying, oh, I heard that Palantir is a good stock. Land said he likes Palantir, so I went and bought a bunch of Palantir. But then I lost money, so I think Land's stupid. He doesn't know what he's talking about. That's not how you should trade. That's not a very bright method. You need to be systematic about your trading, and you need to understand the market and the concepts behind it. And so there's a process called the accumulation and distribution model. Now, if you come to these classes and you don't ever learn anything else, the most important thing you can learn is the accumulation and distribution model. I don't care what else you learn. Everything else to that is superfluous, right? It means nothing comparatively to the accumulation and distribution model. The accumulation distribution model is the single most important thing you can learn. So if you turn off this video right now and you go out and you study for the next 6 months the accumulation and distribution model, you will be better off than 99% of everybody else in the entire stock market. All right? Because understanding that concept is paramount to your success. So if somebody comes in and says, oh, I really like Palantir stock, you know what to do. You know to go in and analyze it from an accumulation distribution point of view. Now, I've simplified the accumulation distribution point of view, made it as simple as I possibly can for you. The accumulation distribution, really, when it comes down to it, is buy low, sell high. There you go. All done. You can turn off this video and go be rich, rich, rich beyond your wildest dreams now, because you know the secret of accumulation distribution. Buy low, sell high. And you're like, man, you're not teaching me anything I didn't already know. Well, then the question I have for you is, why aren't you doing it? Oh, yeah. Because I like to buy high and sell higher. That's me. I like to buy markets that are doing well. I like to wait until they're really up high, breaking 52-week highs. I'll buy that all day long. I'll buy big markets that are making. I don't like to buy bad markets that are doing poorly. I only want to buy good markets that are doing well. Well, if you buy good markets that are doing well, it's a really hard strategy to buy high and sell higher. All right. Let's come in here and look at GE Vernova. Right now, there's a lot of people buying into this market. Why? Because it just broke the previous high over here, and it's breaking all-time new highs. I'm going to be rich, rich, rich beyond my wildest dreams. I'm going to back the truck up, sell the house, buy the car, sell my kids, sell the children, sell the tractor. I'm going to buy right here because this is a great market. Now, could it go up from here? Yeah, it certainly could. But are you going to sell if it does? Hell no, I ain't selling land. I'm a buy and hold investor. I invest in markets. I don't sell them ever. Okay, well, how are you going to make any money? Well, I'll just make lots of money because I don't ever sell it. Okay, how does that better your lifestyle? Well, I have lots of money. Okay, good for you. That's great. You got to sell it at some point. Buy low. What's the other side of that? Sell high. Okay. So if you buy and hold and you never sell, well, I'll sell it when I'm 114 years old, or I'll sell it one day. Oh, I will. I'll sell it one day. Okay. Well, that's a good idea. You bought it way up here, and one day you might sell it. And when you'll probably sell it is when it comes all the way back down here and tests these low. And you'll say, oh, shit, I think I'm going to sell. And so that's what happens to most traders. Now, you might be the exception to the rule. You've never done that in your life. You've never bought anything that was doing really well and then sold it when it came down and lost a bunch of money. Now, I know that nobody in this class has ever done that, because nobody ever does that, because you've all taken my class and you know you're supposed to buy low, right? You're supposed to buy low and you're supposed to sell high. And so that's what we talk about in this class. We talk about how to know when to buy low and sell high. Well, that's stupid, Lan. I know that. I could do that all day long. Okay, I'm going to come back and ask you the same question. Well, then why don't you do it? Why are you still buying up here? Why are you so excited about a market that's up here, but you weren't excited about it down here? I was excited about it down there. I was excited about it because it was going down, down, down. I thought it would go down some more. So I waited till it started to go up. And then when it got up here, that's when I got really excited and I bought it right here. Okay, well, do that then. That's a different class. That's that guy over on the other channel. All right. I know lots of people who will tell you to buy right here. They will tell you to buy right here all day long on other channels. All right. But for me, not so much. I don't like to buy way up there. So what I like to do is I look for what we call the accumulation distribution model. Now I have a little indicator down here. It's called the chalk and money flow. And the chalk and money flow tells you when you should be buying. All right. It's green down at the bottom. And it tells you when it should be selling. It's red up at the top. You should be selling right here. Okay. You should be buying all through here. You should sell out up in here. You should buy some more down in here. You should sell out up in here. Now, you want to do it strategically. This is just an indicator that kind of gives you an impression as to when the market is down in buying zone and when it's up in selling zones. But it doesn't mean, oh, it's just go and sell it all at once. We don't do that. We ease into markets and we ease out of markets. All right. So you buy a little more, buy a little more. It's called dollar cost averaging. Now, you got to be careful, because there's times when a market you can start going down, right? And it can just keep going down, 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 and down. And then you never recover. And that sucks too. And we don't like to do that. And we want to be careful with that too. So we need to count, measure, and look at the probabilities. And when we trade, trading is all about the probabilities. So we're looking for the probability that a market's going to rise in price and when it's going to do that. And in the process of looking for the probabilities, we need to understand what the probabilities are. So the way we do that is look back at history. Past performance is not necessarily indicative of future results, but it's the best we got. So if we want to look at opportunities or time frames when a market is at a buying zone so that we can buy it, and we want to start dollar cost averaging into it, we want to be careful. We don't want to just jump in with, sell the farm and sell the tractor and put it all in the market at one time. We want to kind of ease into that market as it comes down into high probability locations. And then as it gets up into high probability times that it's going to turn around or be at the top, we want to start to ease out. All right. Ease out of the market. So we ease in and we ease out. All right. It's called dollar cost averaging in, dollar cost averaging out. It's the accumulation distribution model. All right. So we're going to come in here and I'm just going to draw you a little picture up in here. Very quickly, the picture starts like this. What we do is we come in and we go A, B, C, D, E, F, G, H, I. Just like that. It's like counting. It's just like kindergarten. All right. So this is a standard, what we call an Elliott wave. And you're like, well, Lan, I've heard of those before. I don't pay much attention to those. Well, this is your probability statement of the market. Now, the market doesn't always do perfect Elliott waves, but you'd be surprised how often it does. You know why it does? Because when I was at the Chicago Board of Trade, I sat in on classes where guys were being taught how to write quant systems for their management of large mutual funds, all right, stock funds. So I got to sit in and learn from people who were doing it, and that's how they did it. They would write systems that would help them generate income through the process of quant style systems. All right. They would computerize their programs to do this stuff. And this is what they would do. All right. So that's why this is kind of baked into the pie. This is kind of the fundamental structure which these guys use when they write their big computer systems. And how do I know that? Because I was at the Board of Trade for about 10 years and I saw them do this. All right. I watched them teach this. And that's where I learned it. Okay. So if you're like, well, this is olden days, they don't do this anymore, you'd be wrong. All right. Olden days, how in the 1900s, how did you make money in the stock market? How about the 1800s? How did you make money in the stock market? You bought low, you sold high. That's how you make money. Buy low, sell high. I don't care what it is, whether you're selling cars or candy at the grocery store or stocks. The way you make money is you buy it lower than you sell it for. All right. And you have to sell it or else you don't make money. All right. If you don't sell it, if you just hang on to it, what good is having an asset that's so valuable that it doesn't ever return to you any money? All right. You got to either rent it out. In a real estate example, you have a great big building, you have a house or something. If it just sits there, you say, well, it's increasing in value. Well, to get the value out of it, you have to sell it. All right. Or you can rent it, right? You can get rent from it. But nonetheless, you have to buy low, sell high. And it's been the way it's been forever. And so this is baked into these systems that they're using in the computers. And we want to reverse engineer that. So the first step of understanding how to reverse engineer the quant systems that make these systems work is understanding the Elliott wave. All right. The Elliott wave is part of the accumulation distribution model. So what we do is we come in and we see that markets have a tendency to run. All right. They make a run and they do their first run. We don't know when that's going to happen. All right. It's going to depend on a lot of different things. Generally, it's some sort of a fundamental reason that drives the long-term trends. And then the technicals are driven by the shorter term trends. But the technicals tell us the setups and the triggers for the entry into the longer term trends. That's why you can't just do one. You can't just trade off the fundamentals because you don't know when the market's going to set up and trigger. And you also can't trade just off of the technicals because you don't know when the long-term trends are going to ensue. You don't know what's going to cause a market to have a long-term trend. Usually it's some sort of a fundamental economical type of an event that's going to cause that to happen, all right, for the long haul. So we need to have positive economic news to give us a long-term trend, but then that doesn't set up and triggers and gives us all the trading algorithmic take profit and entry points. So we need technical analysis to do that. And what technical analysis is a method of reverse engineering at this point in time, this point in our time, in our lifetime, right now, our use of technical analysis is to reverse engineer when those big quant systems are going to be entering the markets and taking money, taking profits. All right. So we want to do the same thing they do. All right. We want to be aware of that. Now we can do different things than what they do because if you've been in this class, you understand what they do, and then we trade a little bit differently than they do. And that's because we're small. And so we don't need to trade completely like the algorithms. We just need to know what the algorithms are doing so that we can make money off of the algorithms, all right, or along with them. And then we don't have to necessarily trade the full way they do. We just trade little spits and stops and starts, along the way. But the first thing is we don't generally know when this is going to happen, all right? And so we call this an A1, all right? It's the A1. So we call this, generally speaking, the markets have a tendency, and the computer systems, the quants, have decided that they like to move the market in three basic fundamental drives, all right? So that's what they anticipate that the market's going to do. It's going to go in three drives like that. We call it three-drive pattern. So this is what I call the A drive. This is the B drive, and this is the C drive. If you're familiar with, if you've done any Elliott wave theory, then you know that this is called the X. This is 1, 2, 3, 4, 5, A, B, C. All right. That's a standard counting method of an Elliott wave strategy. All right. So X is the first one. I call that the A1. All right. Now I've changed the way I count it. I haven't changed the rules, the theories, anything about it. All I've done is just made a better way to count it. All right. And I made it that way because I've been a school teacher for 30 years. And students have a hard time with the Elliott wave theory. All right. So I made it very simple and very easy, and I totally redesigned the way we count the Elliott wave. So I just call this an A1. And why do I call it A1? Well, I call it A1 because this is the A drive, A, B, C. Right now, they don't call it in the, if you go out and you look in the Elliott wave theory, or you go out and look in accumulation and distribution, you're not going to see them call these A, B, C drives. Why? Because Land Turner made this up. All right. I made this up for my students. This is the beginning of the, so this is the B drive, B1, and then this is the C drive at C1. So very simple, very easy, ABCs, right? So we're just going to count these as ABC drives. Now, inside of these, we have a word called fractal. And fractal means that the market comes in and you start off with, let me do the little Elliott wave one more time. So what we do is we make little Elliott waves inside of big Elliott waves. So now we come in here and we go X, 1, 2, 3, 4, 5, A, B, C. Just like that. All right. So that's a little Elliott wave inside of a big Elliott wave. Now, in the interest of time, I'm not going to draw one for every time, but there's a little Elliott wave inside of each one of these. All right. Just like that. So there's little Elliott waves inside of big Elliott waves. Now, because of that, what we do is I come in here and I say, look, I'm going to relabel these for my students so that they understand how this works. So that's the A1. That means in the A drive, we're going to have a second entry point. The market's going to rally and then it's going to pull back. So we have an A2. All right. And so now we come in here and this little spot right down in here, this is an A2. Now, many of you have heard of different recurring price patterns. You've heard of things like pennant formations, head and shoulders formations, narrow sideways channels, triangles, all kinds of little recurring price patterns, right? So in the process of little recurring price patterns, that's where these come in, these little recurring price patterns. And these are called pennant formations right here, right? So you'll get a little pennant formation here, and then we come in here and we do this again. We do one more time. We come in here and we say this one right here is the A3. So this is A3. And then we come down here and we look at this and we say, okay, there's an A3. Now, if we go up and traditionally speaking, this market comes in, again, that's going to be a little pennant formation right down in there, little pennant just like that. All right. So that's where your pennant formations come in. And so this is what we call a drive, right? The first drive, the A drive. So it's the A drive with the first pennant, the second pennant, and then we hit the peak right up in here. Then the market generally turns around and comes back. And so this is the little ABC retracement that comes back down the other side. And then we start the new drive. This is the new B drive. Now, if we have a little, again, in the interest of time, I'm not going to sit here and do every single one, but you can see this is going to be a B2, and then we're going to have a B3, just like this, and it starts all over again. Now, the reason we do it like this is because Land Turner has created a little probabilities table out of this. All right. What's the probability that you're going to catch an A1? Well, it's relatively low, because you don't know when the new A1s are going to start. You're going to be listening to the fundamentals. You're going to be watching the technicals. You're going to be trying to figure out when a market's going to take off and run, right? Because if you come down here, you got to know, well, is it going to take off and run here? Is it going to take off and run here? Is it going to take off and run here? Where is it going to run? Well, there's a coming down the other side. We have to look at the probabilities of that as well. And we do that off of this backside over here. As the market comes down off the backside, we want to know how far down it's going to come, and we're going to count and measure those so that we can look for the first either A1 or A2 or whatever it is that we want to get into to try and capture the reversal. And as the market turns and starts to go again. All right. So that's the starting. This point right here, is the same as this point right here. Okay. So that's the same. These are the two same points on the model that we're creating here. And what are we doing right now? This is creating the algorithmic model. This is the actual fundamental structure of an algorithmic model. Okay. And this algorithmic model is built into an algorithm called BlackRock. Now, how do I know that BlackRock uses this model? Because I've seen it happen a million times. All right. I've been doing this for 30 years, and I know the more and more and more that these companies all start turning to computers, the more and more they do this. And I learned this at the Board of Trade. I watched them teach this concept to the people who are now running those big computers. They were kids at the time. We were all kids at the time. Now those kids are working on Wall Street. They're the ones who went in and they wrote these systems for these quant systems because they learned this at the Board of Trade at the same time I did. All right. Now I came and wrote software myself. The software that we're using right here is the software I wrote after I come out of the Board of Trade. All right. There's 100 different quant systems, little small miniature quant systems inside of this track and trade software. Oh, you've never heard of track and trade software? Here, let me tell you where you can get it.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so that's where you get the software that I wrote when I came out of the Board of Trade. All right, now I wrote it while I was at the Board of Trade, and that was how we came up with all this stuff, because that's where I learned it. So I learned all this stuff at the Board of Trade, and then I'd run back to the programmers, and I'd tell them to write it, and then I'd go back to the Board of Trade, and I'd learn more stuff, and then I'd come back, and I'd tell them what to write, and then I'd go back. That's what these other guys did too. And a lot of these guys ended up on Wall Street, and they ended up writing this stuff for big companies like BlackRock and Vanguard. All right, so that's how this works. That's why I did what I did with my career in my lifetime. That's what they did with theirs. And they put this stuff right into the software just like I did. Okay. Now, those guys, some of them are running great big, huge firms, great big companies. They went and did it. I did a little company. They did a big company. There they went for work for BlackRock. I went and worked for myself. But nonetheless, we all came out and we wrote the software and the systems around this stuff that we learned at the Chicago Board of Trade. Okay. That's what we did. So I'm teaching it now to you what they taught to me. Now I've changed it because I went into education and schooling, and I taught at colleges for a long time. And so I'm telling you how I've changed things around a little bit, but it's still the same concept. We just label it differently so that you guys can understand it a little bit better of what's going on. So I'm telling you what they taught me, and this is what we put into the computers, and this is how we make computers trade. So that's why this works. It's because it's been programmed into these great big computer systems. All right. And so we can reverse engineer. We can go down and we can look at the markets and we can say, hey, the markets are doing what the quant system is in control of. And so we have the B drive, C drive, and then now we have the C1, C2, C3, and then we come back down off the other side. All right. So that's the whole name of the game. That's what we're looking for. Now, the probabilities come in, and I've created a book. And again, I told you it's out on Amazon. You just go search Lan H. Turner. You got to put the H in there. It won't come up. Lan is my first name, Lan H. Turner. And it has the probability table in there of what this is. But the probabilities are pretty obvious. I mean, if you got any kind of brain in your head, you can see that the likelihood of an A3 continuing higher is less than if an A2. A2's got more of a probability that it's going to rise higher than A3. A1's got more of a probability it's going to rise higher than A previous than the A2, right? But the A1, the problem with the A1 is we don't know when that's going to happen. So I oftentimes say, don't chase the A1s. All right. Wait for the A1 to happen. The market's going to take off and run, but then it's going to give you a little pullback. It's going to give you one of these little pennant formations in here. And then that's going to be the A2. And you can get in on the A2. All right. A2 is generally where we get in. And then we don't like to add at the A3, or we can add at the A3, but we don't want to get in on a new trade at the A3. Why? Because it's only going to have one small run of break above the previous high, which is right here. So if the previous high was here, and A3, you get in right in here. Well, it's only got a little spike up in there before it's going to turn and flush back down and come back down and make a little retracement down in here. And then this is what we call a triangle formation. So those of you who are like, oh, I just trade triangles. Well, what you're doing is you're trading this part of the market right here. This is the triangle. All right. So you have pennants, which are small, little tiny triangles. They're right down in here, right? So the little tiny triangles, little pennants, right? Or flags, sometimes we call them. So you get little pennants and flags down in here. And then the triangles are this section in here, between here. So that's where you get your triangles on this model. And then that's where you will trade the breakout to the rally and the next rally up. And that's the B1. And then you're going to go through the whole process one more time. And it's just going to be another little, oh, that didn't draw very well. Land, draw. So then you're going to get your little pennant formations in here. And then you're going to get another triangle formation in here. All right. So there's another triangle formation or a wedge pattern. And then we get the C drive. We go up C1, C2, C3, and we get up to the top. And then some of you have actually even heard of a head and shoulders formation, all right? Head and shoulders, or a 1, 2, 3 top formation. Some of you call them 1, 2, 3 tops, or head and shoulders. Well, a head and shoulders is just this left shoulder right here of this pattern, of this Elliott wave. That's the neckline. That's the head. That's the neckline. That's the right shoulder. All right. So that gives you the head and shoulders formation. And that is generally considered a reversal pattern, right? Higher highs and higher lows turn into lower highs and lower lows. And that's what a head and shoulders pattern measures for us. All right. So that's your left shoulder, your neckline, your head, your right shoulder, and then your neckline. And then right there is a breaking of your long position. And generally we'll find that to be some sort of a trend line that we might draw underneath the entire trend. And so I've been trying to make it a little bit simpler for people and call them little mountains. All right. We come in here and so you draw your natural trend line up underneath there. So you get this first triangle formation right here, this little, what I call a little mountain, right? So we call a little mountain and we come in here and we draw our little mountain in there. There's mountain 1, there's mountain 2, there's mountain 3. And then you're going to get this little pop up in here. It looks almost like a little mountain 4, but it fails. All right. So that's your little mountain 4, but it fails. It no longer makes higher highs. See how this makes a higher high and higher low, higher high, higher low, higher high, higher low, higher high, higher low. And then this one comes up, tries to break this previous high, can't, makes that right shoulder and flushes and fails. Now, how far down does it go? Now we have to go in. This is the counting. All right. We have count, measure, setup, trigger, follow through. So this is all counting. This is how you count the markets. And you're like, Lan, this is a bunch of bullshit. What are you talking about? I've never seen that in a market. Look, it's right there. It's right here. It's everywhere. It's these little 3 drive patterns. Now this market is one of these craziest things I've ever seen. But nonetheless, if you draw your trend up underneath there, this is all drive 1. All right. So this is your A1 way down in here. So this is A1 right here. And again, what I've got drawn up here, this is perfect. I mean, right? This is a manual drawn version. They rarely look this perfect. Now, sometimes they do. They look exactly this perfect. It's amazing how perfect they'll look. All right. And you get it all the time. But this is our first drive. And then so we come in here. That's your A1. And then you get this little pullback in here. You have your first little pennant formation. That would be an A2, right? So that little pennant formation. Now, since I created this strategy, all right, I've changed things up a little bit in the way I do stuff. And so I've had to adjust, and my counting has come a little bit far, all right? So this one here would be the A3. Now, it doesn't mean it can't go to A4, A5, A6, A7, A8, A9, A10. It certainly can. And in this case, it looks like we've got an A4 on this one right here. This market is just unbelievable. All right. So you got an A4 right there. Now, what makes an A3 or an A4? Well, it's the little pennant formations. How many little pennant formations have we got going up here? Now, it's got to be higher highs and higher lows. So see how we're making higher highs up here, and then we get a low right in here. So see that right there? This is just a nice little trend line up in there, and then it breaks, and it gives you this little pop down here. See how this market broke down here? This lower low came down, and then there's no longer making higher lows, making lower lows. And then it came up and it did it again. You have all these higher lows, higher lows, higher lows, higher lows, higher lows, and then right here it broke. So now you're no longer making a higher low right there, so that becomes your A3, okay? Again, these are pennant formations. There are little pennants in here. Now, one of the things, before I talk about that, let's come in here. So there's a little pennant formation. Here's a little pennant formation. And then as you go up, look, there's one right there. See how it's got a nice little pennant looking formation. It's not quite, you're like, wait a second, what's wrong with that pennant formation? Here's a pennant formation right here. What's the difference between this one and this one? And the reason I say I had to make I've been making a little bit of a change to my counting method because I started using a tool called Heikin-Ashi. All right. So this is what the market generally looks like. That's without Heikin-Ashi. All right. And this is also without the bulls and bears. Let's take the bulls and bears off. So this is what most traders are looking at. So I like to cheat because I'm a cheater. When it comes to the stock market, I don't want to do anything illegal, but I do like to cheat. So I put on my cheat codes, indicators that we've created for this purpose alone. And one of them is called bulls and bears. All right. And it comes in, it turns the price bars red, yellow, and green. And I'll explain that in just a minute. But as we come through here, this gives us this nice little trend. And then what we do is we come in I use something called Heikin-Ashi. Now, Heikin-Ashi wasn't around when I was back in Chicago, but it's around now. All right. And I like it. I like it a lot because what it does is it smooths out the price bars and gives us almost, this is the one I call the cheat codes. So we come in here and I'm going to flip those on and you can see it just kind of smooths things out. All right. Now, the problem with this is that it makes my counts a little bit wacky. All right. So I have to come in here and you'll notice that I'm getting lower highs right here, but I'm still getting higher lows. So you're like, well, what happened there, Lan? It's half of your account. It's not an A3 because it didn't break the lows. It's not making lower lows, but it's making lower highs. So Heikin-Ashi is kind of throwing a little bit of a wrench in my banana here. And so I've started to count these a little bit differently because it's only half. It's not a full break like an A2, like this A2. See that full little lower highs and higher lows, right? So broke that completely. That's obvious. This one here did the same thing. We broke our lows, we broke our highs. This one is a half. This one is a whole. Higher lows. This one only broke the highs, but not the lows. So I call this one an A2.5. A2.5. To me, it's funny, all right, because this is not something we ever talked about in the Chicago Board of Trade because we didn't have Heikin-Ashi bars. So then I come in here and I call this one a 3.5. All right, because it's not an A3, it's not an A4 because it didn't break the lows. A4 has to break the lows. So I've been being silly. And sometimes I've seen in these markets, some of these 100 club markets, I've had to have an A2.75 because it broke another highs, but not a lows. It made an obvious, downtrend like this, but still didn't do it again. So we've had to have an A2.75. So it's just, to me, it's funny. It's a math joke. All right. Those of you who find math jokes funny, you'll laugh with me. Those of you who don't find math jokes funny, well, it's just, it's not a perfect A1, A2, A3. So we have to do something else. To me, it's funny. All right. So we're going to come in here, and this is how we're going to count these waves. All right. Once we get up into the A3s, A4s, the probabilities of this market going any higher are really low. All right. We need to get this little pullback in here. We need to get this little pullback, this drawdown, this little ABC pattern that comes before we can start a whole nother drive. All right. So we'll keep waiting for that break. Now, see this little blue line that comes in here? These are the parent to that is the parabolic SAR, but this is not the parabolic SAR. It's just another little dot system that we've created kind of based on the parabolic SAR concept. All right. But I call it the blue light, and it comes with the bulls and bears. Now you can tune if you don't have the bulls and bears, you can kind of use the parabolic SAR. I prefer the ATR. Which is another one we got in here. This is the ATR, but you're not going to get the ATR and the parabolic SAR. You can get the parabolic SAR to get a little bit closer to the blue lights than the ATR. But you can try and tune them in a little bit like this to try and get them to work. All right. So, but they're a little bit different. But they're all just a little bit different mathematical models. The blue light is the one that I like to use for this purpose. All right. So we're going to remove the ATR. So the blue light is what I'm going to call. This has been tuned in to what I call the BlackRock algorithm, right? So it's been tuned in, and I'll show you the settings so you know when it's tuned in, what the settings are, so you don't get the settings screwed up. So we come in here. These are the settings. Sensitivity of 72 is the slider. So make sure yours is on 72, and make sure you're using the progressive formula. There's a traditional, a progressive, an aggressive, a Bollinger Band, a Keltner Band, 10x8 Mac. Use the progressive formula. That's the one I like, all right? And then we come down here, and you can show blue lights. That's the one that turns on those little magic blue lights right there that tells you the drives of the market. That's how we know when we're in the A drive, the B drive, or the C drive. So we turn those on. And then we have arrows on all color change. That's just fun. You can turn those on. It just, every time the market changes from and we haven't talked about that yet, that's Fibonacci. So we're going to come in here. And you can turn those on, turn them off, whatever you want. And I turn them on sometimes I turn them off. Depends on what I'm doing and what I'm seeing. So that's just your arrows to help you know when the market's changing from bullish to bearish. All right. From neutral to bullish or from neutral to bearish. Okay, so that's our count system. Now what we have to do is we have to go to the next step. All right. So the next step, and obviously I think it goes without saying, these are your buy points. All right. A1. A2, this is where you're going to get into the market. This is where you're going to accumulate your shares. All right. This is where you're going to buy in. And the higher you get up that level, the less likely it is that you're going to make money. So buy low sell high. Again, that comes back to the probabilities. The probability of you making money if you buy it in A4 is very low. Doesn't mean you can't. It could go up a little bit farther. It could go up to A5, A6, A7, A8, 9, 10. Some of these markets do. This one is one of those, GE Vernova. Going up beyond 3 is really rare. All right. So going beyond the 3, A1, A2, A3 is really rare. Doesn't happen very often. Here we are at an A3.5 and then an A4, and this market's still going, which is just unbelievable. Okay. It's unbelievable. So what we're going to do now is we're going to measure. What we expect this market to do is break down. All right. It's got to break those blue lights. Lan, it's never going to break those blue lights. Those blue lights, it'll never break them. It will. I guarantee you, it will break those blue lights eventually. All right. And usually it breaks them around the top of the A3. That's the normal place. Probabilities doesn't mean it does it every time. That's what a probability means. It means that more times than not, it breaks at the just above the A3. So the reason this is in our class, right, is because it's odd. It's not doing what it's supposed to do. It just keeps going and going and going. It's part of this 100% club. So it's breaking the rules. So it's not really breaking them. It hasn't broken any rules. It's just continuing up into the A3s, A4s, A5s, A6, which I always say it can do. It's just really super rare. All right. I don't want to be a buyer at an A4. There's no way in hell I'd buy this market right now. I would probably be, if I had any, and I wish I did, and I don't. But if I had any of this, I would be completely out almost right now. I would have bought all down in here and I'd be out. Now, I did do this on Palantir, and we'll go over and look at Palantir. I did buy that. I put $100,000 into Palantir, and I rode it all the way up through all those, added in as we went, and then started taking off as we started getting higher. And so I'm going to show you how that one worked out. But this one is one that's getting ready. I'm looking for it to break. This is a great market. I want you guys to have this stock, but don't buy it right now. That's my warning. All right. So we're going to come in here and we're going to draw what we call a Fibonacci ruler. Now, at this point, we don't know where the top of the Fibonacci ruler is. All right. Now, the Fibonacci ruler, we have count, measure, setup, trigger, and follow through. So we've taught you how to count. All right. This is how you count the waves. Now we're going to show you how to measure them. So what are we measuring? Measuring from the low to the high. Now you can also come in and you can measure the little waves in here. So let me get rid of some of these little circles because we don't need, if I can, all these little circles. Oh, there are too many layers in here. I'm going to leave that one. All right. So we're going to come in here and we're going to take our Fibonacci ruler and we can measure from the very first A to the B. And you're going to see that's where you're going to get your little pennant formation. The market has a tendency to come back down into that, what I call the Fibonacci sweet spot. And you can measure each one of these little wave patterns. And all you're doing is measuring from the high to the low, up to the top. And then we're going to look for the market to come back down into this little Fibonacci sweet spot right down in here, right? So a 50% retracement. It's actually 38.2 to 61.8. 50 is not a Fibonacci number. It just happens to be halfway. All right. So then we take that little ruler and we go and we measure the next one. And then we take that little ruler and we measure from the very low to the very high of the entire drive like that. All right. So we measure each little one, and then we can measure also, we can take our little Fibonacci ruler and we can measure this one, and we can measure this one. All right. And then we measure all the way from this one to this one. All right. And then we have the market has a tendency to come back down after it makes this great big ABC up here, back down into the Fibonacci sweet spot, which is where we look for the market to come back down into here. That's where we want to be a buyer. All right. We want to be a buyer when the market pulls back and makes that little ABC retracement off of that 3-drive pattern. Now, it can make 4 drives. It can make 5 drives. It can make 6 drives. But once it comes back down into this Fibonacci sweet spot, that's where we start adding back in. Buy low in anticipation of the next rally. Now, just to give you a little idea, we call this entire thing right here from beginning to end, we call that a Darvas box. All right. So one Elliott wave is one Darvas box. Okay. And then we anticipate the market breaking out and going and starting to rally and starting a new Darvas box. So we go 1 Darvas box, 2 Darvas box, 3 Darvas box. Inside of each Darvas box are smaller and smaller Elliott wave patterns. Okay. Buy low, sell high. Higher highs, higher lows. That's the whole nature of the whole beast right there. If you understand that concept, you understand the accumulation distribution model better than 99% of everybody else who's out there trading. And this is what's programmed into all the computers that are trading these great big systems like the Aladdin system. This is what they're doing right here. All right. And that's why it works. Does it work every time? No, of course not, because there's all kinds of people out there trading who don't know anything about this system and they screw it up. So the system has to adapt. All right. So the system, the computers are all trained, are all programmed to adapt that when this doesn't happen, what are they going to do? All right. So they have all kinds of caveats. And if you go get the Elliott Wave book, it's about that thick. And I always tell everybody, for our purposes, you can just take the first chapter and tear it out and throw the rest of the book away. Because all you really need is this first chapter. This is the first chapter of the Elliott Wave book. Now, in my book, I wrote my book and I did the count, measure, setup, trigger, and follow through. And basically, this whole structure that I've just outlined to you is one chapter in my book. All right. So I show you how all this works. And then we have to have the rest of that book, that great big huge fat Elliott Wave book, as all the caveats. What do we do when the market doesn't do the perfect thing? Well, if it does this, then you have this caveat. If it does this, then you have this caveat. And if it does this, you have this caveat. And so there's a million caveats. And the reason they have all those caveats is because they have to program those into the computer so the computer knows what to do, right? The computer can look at it and say, oh, I got all these damn caveats that I have to deal with when the market doesn't do exactly what we programmed it to do. So some ding dong came in and did a news event and it caused the market to screw up and a whole bunch of retail traders went and bought it. And so now it doesn't look like our Elliott Wave pattern anymore. So then the computer system says, well, if it doesn't look like our Elliott, what am I supposed to do? Well, look at one of the caveats. Oh, the caveat says I'm supposed to do this. Okay, so it goes and does that. That's what that is. All right. You can't know all that. I don't expect you to know all that. Don't even try to know all the caveats. It'd be ridiculous for you to try and know all those caveats. All right. You're not a computer. You're an individual trader. So we just need to know the overall broader function of the market. Has a tendency to make 3 drives, and inside of each drive there's generally little 3 drives, and that's where all of your little patterns come in, your little pennants, your sideways channels, your little triangles, your little head and shoulders formations. All those little patterns you've learned are built inside that model. Okay. Now, this is the retracement model. It's called the Fibonacci numbers. Now, the Fibonacci numbers, again, they're programmed into the computer. Where do they expect the market to go? Well, back to somewhere half or 50% of the last major move, which is what I call the Fibonacci sweet spot. So they program the computer to come in here. Now, I've got this over here in another little table. I'm going to try to remember to turn this on and not forget that I got it on. So this is called the delta cone of probability. Now, that's my name for it. If you go out and search delta cone of probability, you won't find it anywhere on the internet because I made that name up. The real name is 68-95-99.7 empirical data distribution rule. So if you're going to study this outside of this class, that's what you're going to search in ChatGPT or on Google, and you're going to look up the 68, 95, 99.7 empirical data distribution rule, and that's what this is. And what this is really all it's saying is that the market likes to come back to one standard deviation. So what we do is we think of this first drive in the trend, the first drive in the trend, remove, replace. There we go. So the first drive in the trend is the one standard deviation. The second is the second standard deviation. We're going into the third standard deviation. Now, this market has gone up into 4 standard deviations. That's fine. It can do that. But the tendency of a market is to come back into the one standard deviation of the overall longer term trend. So we've gone up 1 standard deviation, 2 standard deviations, 3 standard deviations, and we're up here at the top. We're up into the 4. But then the market wants to come back. If we come back over here, 68.2% of the time. Now, is that 100% of the time? No. Is it 75% of the time? No. Is it 90% of the time? No. Is it 20% of the time? No. It's 68% of the time, 68.2% of the time. So not all the time, a little bit more than half, about almost 70% of the time, the market likes to come back down into that little circle that I drew. All right. That's what that's telling you. And it says that around 95.4% of the time, it comes back into the 2 standard deviations, and nearly 99, almost 100% of the time, it comes back from 3 standard deviations into the 3rd standard deviation, or goes out into the 3rd standard deviation. So this is both projection and retracement. So we got another one here, tools to analyze mean revision, the Fibonacci ruler, Bollinger Bands, RAF channels. There's a number of tools that you can use to measure these tools. Most of you heard about Bollinger Bands. That's all Bollinger Bands is doing. It's measuring the market moving through one standard deviation. Now you can set your Bollinger Bands to do 2 standard deviations or 3 standard deviations. You can do whatever you want. All right. It's just a math model. And then the application of trading, entry point, risk management, and options trading. We use the mean reversion, right? Calls and puts, all this kind of stuff. That's how you know where to buy and sell your options at, based on the mean revision or this 1, 2, and 3 standard deviations. It's just little, the reason I turned it sideways like this is because that's how we look at charts. All right. But the one that's most important to us is this one here. Okay. So the market's coming along, and you can see I've turned this sideways so it's not sitting up. Mostly if you go out on the internet and look and study, it's going to be sitting this way, and it'll show you this kind of a normal bell curve. I picked that bell curve and turned it sideways because I want you to imagine it sitting on, let's see, got to remove this one, replace this one. So you got to see it sitting sideways. So this Fibonacci ruler is that, does that make sense? It's that bell curve. So this is the bell curve turned sideways. That's what the Fibonacci ruler is. It's a bell curve turned sideways. So you would be seeing the bell curve. It'd be like this. All right. So we come in, and here's the bell curve like that. See that? I'm such a good artist. So that's your bell curve. All right. All I did is turn it sideways, and we lay it over the top of the chart so you can see where the market's going to come back to that 1 standard deviation, which is right here between 38.2 and 61.8. I call it the Fibonacci sweet spot. All right. All it is 1 standard deviation. This is how I was able to predict that the market was going to flush that big flush that we had a couple months ago, right, in the S&P. When it was making all those highs, I said it's going to come back to the 1 standard deviation. I drew the 1 standard deviation across there. I said that's the number, and boom, came right down to it and touched it, almost like a train on rails. Everybody was like, wow, Land must be time traveler. How did he figure that out? Well, I just drew a Fibonacci ruler over the top of it and said it'll probably come back down to here. And it did. All right. So I had a 68.2% chance of being right. And so that's what I think this market's going to do. It's going to break those blue lights. That's what it's got to do. When it breaks those blue lights, that's the point where it's going to probably come back down. And now the first spot is 38.2. And it can come down to 50 because a lot of people will read the 50. That's not really a Fibonacci number. It's just halfway between. And then we got 61.8. So 38.2 and 61.8 are our Fibonacci numbers. Now we got 2 more in here, and I don't turn them on very often just to keep the screen clean. There's a 23.6, and there's another one down here called 78.6. All right, right there. So you got these other Fibonacci numbers. So market could come down. It can, depending on how strong the market is. Palantir only came back to 23.6, and then it took off again. I think we'll go look at it. And then you see it come down to 38.2, and then it can go up and then come back down. So it doesn't go perfect, right? It goes in waves. But as it goes through this, it can make a little wave coming down, just like we drew up in our pattern up here. That's how we know how far to expect the market to come down, and that helps us know when to be a buyer. So as it comes down and it touches these different locations, we're going to anticipate the market's going to turn around and go back up and start a new Darvas box, bullish market, bullish new Darvas box. Okay. So now as it comes and pulls back down into this region, this is where we're going to start to be buyers again. So you can be a buyer at 23.6. I usually don't. I usually wait and see if it won't come down to 38.2. 38.2 is really common. Now it's got to go through 38.2 before it can hit 61.8, right? So it's going to obviously go to 38.2 more often than it's going to go to 61.8. But that's only because it has to go through 38.2 to 61.8. And sometimes it stops at 38.2 and takes off again. So it never got to 61.8. So 38.2 is a higher probability that the market's going to stop there, but it doesn't mean it stops there all the time. That's not what that means. It just means that it's got to hit 38.2 before it hits 61.8. It's going to hit 38.2 every single time. 100% of the time, it's going to hit 38.2 if it hits 61.8. Has to, right? That only makes sense. That's coming right out of your high school probabilities class, all right, math class. So as we come in here, we're going to anticipate this thing coming down. And as it comes down and hits 38.2, that's where I like to start to buy in. I'll buy a good chunk, 10, 20% of my entire investment that I plan on putting into Genova. So if I plan on putting $100,000 into Genova, I might be putting, if it hits 38.2, I'll put $25,000 in right there. All right. And then if it comes down and hits 50%, I'll put another 25,000 right there. Boom, 25 grand right in there. And then if it comes down to 61.8, I'll put another 25,000. All right. Now I've got $75,000 into this market. Still got $25,000 left. If it comes down to 78.6, I start to bite my fingernails. And I'm going, why is this market not turning around and going back up? It's not supposed to come down to 78.6. 78.6 is a low probability stays. I don't like it to come down to there. If it goes down there, I start getting a little nervous and I hold on, I sit on my hands and I'm like, I ain't putting any more money in. I stopped putting money in at 68.2. Now, if it'll start to wobble around and give me some good signals down in there, and like it's going to turn down in there and start to go back up and cross the blue lights, I'll get in down in here. But mostly I'll wait until it starts to cross back up and I'll put my other rest in. If I could put it in, I'll put it in at 68.8 or up here at 50 as it starts to turn and start to go back up. So I don't put it all in on the way down. I wait for it to turn, start to go back up, and then I put in the rest. Okay. So that's how you level in, and then as it goes, you put in your rest and you can get in on a nice buy signal on the way back up, and you put the rest of the 100,000 in. All right. That's how you do it. So that's all I got to tell you. I just taught you everything I know. Now let's come and look at some different charts. This is the APP, App 11. So you come in and it's the same process. Look, we do this every single time. And we don't know how far this is going to go. Now look, it broke the blue lights. So that's why that's down there, because we got to start a new one. So this broke the blue lights. Some of you said, Land, that's never going to break the blue lights. It's going straight up. I guarantee you, I promise you, every single market will break those blue lights. Has to. It will break those blue lights. Now, how far down it comes, that's the other question. These 100s, you'll notice that when you were in this 100 club, these babies are strong, man. These markets are strong, especially right now on the Trump train, because we're on the Trump train 2. Remember the first time he was in, we called it the Trump train. The stock market just went to the moon. Well, we're on Trump train 2 right now. And so this market, oftentimes, I've noticed some of these, especially these 100% clubs, these really strong markets, they're not coming all the way back even to 38.2. And I haven't seen any of them come all the way back to 61.8. All right. They're just too strong. They break the blue lights and immediately turn and take off again. And the blue light, if you'll notice, that's clear up there at that 23.6. See, it came right down, touched 23.6, broke the blue lights and took off again. So that's what we're seeing here. And this is the nice little, and I put a little smiley face on there. It's an A2.5. Because it had lower highs, but it didn't have lower lows. So it wasn't a full A2 or an A3. It wasn't an A3. It was an A2.5. And then it went up here. I mean, in hindsight, you can go back and you can say, well, Lan, I'm not playing your game with 2.5s. It was an A3. Okay, fine. Whatever you want to do. But what we're doing is we're just trying to wait for it to break those blue lights, count how far back it's going to pull, and then we're going to look for a continuation of the uptrend. All right. I wanted to see it pull back in here so that I could get into this market, but it took off all the way up there. I didn't get a chance to get in. All right. Here's another one. Look at this market. Holy cow. These things are on fire. Unbelievable. It's just like, what in the heck took off? What? Who lit a fire under these damn things? Okay. So there's our mountain 1. There's our mountain 2. There's our mountain 3. And here we are going into a mountain 4. It's just the probabilities of this happening are really low. Doesn't mean it can't, certainly can, but we're going into a mountain 4 up in here. Eventually, it's going to break the blue lights. I promise you. I promise you. I promise you. I promise you. It will break those blue lights. All right. It'll come down and it'll break those blue lights. And then we're just going to keep driving. As long as there's blue lights and they haven't broke, you're going to keep raising your Fibonacci ruler to the top of the next bar. And the higher it goes, the higher it goes. And it'll just keep, notice the 38.2 just keeps dragging up with it. Gets closer and closer. All right. So we're just going to keep moving that up until it breaks the blue lights. That's how you know where to draw your final Fibonacci. Now you can come in and put a little Fibonacci on each one of these. Again, like we said, you'll notice it comes back down into the little sweet spot. See that? Down into the delta cone of probability right there. That one hit 50%. If we come in here and draw it again from the bottom of this one to the top of that one where it broke, well, it was an 8.2. It didn't even come back to 38.2, but I'll bet you that's probably the little 28%er in there. I don't draw that one very often because it's just so tiny. There's not much to it. And then you come in and you put this one in here and it pulls back. See that? It just these markets are not pulling back. They're just crazy. Unbelievable. All right, so we're in the fourth drive mountain on this 100% Avgo. I would really love to have some of this stock, but I can't buy it right here. It's too high. I need it to pull back. I want to see it pull back into the Fibonacci sweet spot where I can be a buyer. Either there. Wouldn't that be nice if we got it all the way back into the 50% level? We could buy into this market and then anticipate another drive just like this one. We want to see another reflection, right? That's what we call that, as a reflection. So we'll go into Exxon. Look at this one. So we got A1, A2, A3, A4. Look at that thing. Never broke the blue lights. It will. I guarantee you, it will break those blue lights. And it will break, and it will might not flush, but it's going to break them here. It looks like it's getting ready to, they're coming into an intercept right in here. It won't be long. It'll break those blue lights. I'd like to see it come back to 38.2. I really would. That would be a great place to buy into this market. But we may not get it. It may only come back to 28. We turn on our 28 or 23, 23.6. We'll see. We'll have to wait and see. Nobody knows, right? Nobody knows. But there, look at that. Coin broke the blue lights. I told you it'd break the blue lights. I guaranteed it. I damn guaranteed it. So there you go. So there's our A2. Look at that. This is an A1. So that's where we broke. That's our A1. Going up, made the little first mountain. There's the A2. Went up, made the second little mountain. We're going into an A3. And the A3 failed. That was an A3 failure, actually. The A3 failed and went into a new B1. So now A3 should have gone up without breaking the blue lights, but it didn't. So we have an A3 fail, and that becomes a B1. So this was not as strong as those other markets. This was a A3 fail. So we want to see it not break the blue lights and go up one more. So it only made 1, 2. Well, this is always that little question I have. So there's 1, 2. It could be 1, 2, 3. And then this would have been A2, A3 down here. But that would put this one back here like this, and that would put this one back here. And we can do that. Oftentimes, that's the way I'll do it. I don't know. And sometimes this gets screwed up down here with this little blue light where it breaks. And so you get kind of, and that one little bar, that's the Donald Trump bar. That's where Donald Trump said, buy the stock market. And it jumped all over the place and it screwed up the mathematicals. So anyway, then we come in here and broke the blue lights right there. So at least we do know that that is a B1, whether that's a A3 failure or whether we put that up there or put that down here. It's a pennant formation and you can buy into it. It's just where the probabilities are of where you think that's going. That's how you do it. Sometimes a little tough, even in hindsight, looking back at it going, I don't know, scratch your head. How to count that. So we come in here but we do know that's a B1 right there because it broke the blue lights. When it breaks the blue lights, that's your reset. Okay. And did it come back to 38.2? Well, it hasn't yet, but we haven't also got the little ABC pattern in here. So we're looking for a little A, B, C, right? So on Coinbase, and then we would look for it to, well, then we might look for it to come down into the 61.8. We don't know. Don't know. I would like to see it down here before I buy in. I got a bunch of this already, so I would like to buy more, but not until it gets back down into here. So we'll see if it pulls back. It could just take off like those others and just go to the moon, and then you're going to go, oh, shit, I missed it. But then you can get in on the B2 as it does a little pennant formation up there. That would be an opportunity to get in again. So there's Carvana. Oh, my gosh, look at this market. That's just the craziest thing I ever saw. I've not seen a market like this in a long, long time. Well, since the last Trump train. Look at this. There's another one. These 100s are just unbelievable. This 100 club, just crazy. Look at this thing. Wow. Okay, Robinhood. Look at that thing. Holy cow, hasn't broke the blue lights again, and it broke, man alive. Holy cow, we're going into an A4. I haven't seen A4s in a long time. Man, look at that market go. Look at this one. Holy cow. Hasn't broke the blue lights yet. Just unbelievable markets. Interactive broker. There we go. That's going to break the blue lights right here. Watch. Oh, I got these. This little CMF, you got to come in and hit reverse formula to put it on the right side. Okay. and then to save that, update all CMFs. So this is your, see this, it's red. Don't buy in there. Don't buy. Wait for it to come back down into the green. And we do the Fibonacci ruler thing. We want it to come back down into this region here. We'd love for it to come down to 38.2. That's where we can buy. If it just breaks and comes to, these markets are so strong. We should probably be buying into some of these at 23.6. Keep that in mind. All right, here we go. What's this one? Ion Q. It broke the blue lights. There you go. And there's the blue lights on the upper side. So draw your Fibonacci ruler in there from the low of the last break of the blue lights to the top of this break of the blue lights. There you go. We're hitting 38.2 right in there. I think it'll come down again. I think it'll hit it again. We'll see. It'll be nice if it comes down to 50, 61, and then takes off and goes to the moon again. That would be nice. All right. MSTR. This thing is not saving my settings. Save, update all CMFs. It's not working. I'll tell the programmers that. All right, look at this one. MicroStrategies, MSTR. I own a lot of this. I own way too much of this. I feel bad buying more, but I bought a whole bunch more right there when I hit 38.2. And I guess I'm happy because it's taken off again. But there it goes. I own way too much of this stuff. I own way too much of this. Is it going to come down to 50 and 61.8? I don't know. If it does, I'll buy more because I like to buy low. I like to buy low. That's what we're looking at. Look at that market. It ran hard today. I ought to go look and see how much money I made. I got a lot of money in this account. That's my MSTR for MSTY. MSTY is the dividend version of that. See, MSTR does not give you dividends. But if you want dividends off of this market, you just go put your money into MSTY, and then they give you dividends. And so most of my money is actually sitting in this one. I'd have to look. I think I sold out all of my cash on this one up here. Probably I'm putting back in. I've been putting it into MSTY because I like dividends. I'm that kind of guy. I like income. Take profits along the way. That's what it really does. There's a really good article. Aiden Gray and I wrote an article that's coming out in the July issue just on this exact thing. We got a really good article coming out in Pit News Magazine talking about going between the two, between your growth version and the dividend version. All right, here's Natera. Look at that one. We bought this one, right? We bought some shares on that one, so it started to take off for us as we started to rally right up through here. And so we got our nice little break. So there's our first drive one. Now it's coming down. There's the little, what we call the triangle formation, right? Which is in between the two drives. So there's your triangle formation. Oh, and you can't drive. Can't draw. There we go. Triangle formation. It broke out the top of the triangle and it's starting to rally. It's breaking those blue lights right here, right now. It's trying to broke them once. Pop back down. Now it's starting to rally again. This will be another good time to buy into this market as we go into the B1 right here. So this is a B1. We like B1s. They're our favorites. B1's a good place to get into a market. So Natera, that's a buy signal. That's a buy recommendation on Natera if you want to get in a little, put a $1 or $2 on there. That one might keep, it's part of the 100 club. NVIDIA, wow, look at that thing. Now, it had a nasty blow off, but it's making that full recovery. Now, we sold some of these premiums up here. We're like waiting for it. We thought it was going to break the blue lights right here, but it's still going. So we got to move our adjustments. Wow, this market. We'll send this to the back. There we go. Look at that thing. It's going to intercept. It's got to break those blue lights. When it does, give us an opportunity to buy back in. But that's still sitting up there. What are we doing on this one? Oh, we're down $20 on those two up there. We were up. We were making money on them, but then this pop today brought them back down. But that's okay because we had a long call on here at 12,725. When are you going to take that call off? Well, it's a 290-day call. So the intent on that one was to ride through this pullback. We'll get a big pullback. If we get a pullback down into the Fibonacci sweet spot, that would be nice. But we could do that. We could take this off. I mean, we're way up here. We expected to break those blue lights eventually, right? And we're up in what we think are the peak. We could take that off. That full 12,700. The gain is 100%. And then we just put it back on when it comes back down here. If it comes back down, there's a problem. It might not come back all the way to 38.2. None of these other markets have. Let's do that though. Let's profit take. Just so, because you guys are here, let's make some money today. Let's liquidate that one. Take our $12,000 off the table. That's not a bad trade. Buy low, sell high. That's how you do it. We'll just mark it out of that, see if it'll take it off for us. There we go. We just took 12 grand off the table. And we'll just let it come back down in here. When it comes back, we'll put it back on. How's that sound? All right. Look for it to go into the second big drive. This is still A1 right in here. This is the A drive. So look for it to go into the B drive. All right. So we got a couple more to look at here. Here's Palantir. You guys said Palantir would never, ever, ever break that blue light. Look at that. Here, I'm going to delete all this stuff. Look, it broke the blue light, just like I said it would. How many little mountains did it make? There's one little mountain. Wrong tool. Wrong tool. Next door neighbor. Okay, one mountain, two little mountains, three little mountains. You think I was lying to you about that kind of stuff? Look at that. Look at that. Can you believe it? Can you believe it? Oh my gosh. Johnny, I missed which one were you talking about on the ES? Oh, you want to go look at the ES? Let's finish the 100s and I'll go look at the ES with you at the end if anyone wants to stick around. So there's our beautiful 3-drive pattern right there. Getting ready to go. That's a B1 right there. You want to buy into Palantir? That's probably the best we're going to get. I know it's buying high, but it broke the blue lights and it's starting to run again. I can't make it pull back farther. We could ask this guy right here. Can you make it pull back a little farther so we have a better get-in point? He says, I don't know if I got that strength. Let's ask this one. This guy, little red one. Little red guy. Can you make it pull back farther? He says, no, I don't know if I can do that. These guys are not my strongest little voodoo dolls. I left my big, strong voodoo dolls down in St. George. They don't travel well. All right, so that's Palantir. Look at that thing. Man, I got a lot of Palantir. But I sold out, so I took profits in anticipation that the market was going to pull back farther, and so I could put some more in. I got a bunch of cash sitting on the sideline for Palantir. Doesn't look like I'm going to be able to put it back in here. We'll have to wait and see. But that's a B1. That's a buy signal. It is what it is. I don't like it, but it is. I wanted it to pull back farther. Where's my Fibonacci? From here to here. I wanted it here. I wanted to buy here, right there. That was my spot, and it ain't going to happen. I don't think it's going to happen. Look, the blue light's gone underneath it again already. What are we going to do? We got a whole bunch of Palantir here. Wouldn't be bad to buy it here. You could buy it here. Over here on this version. See, it hit 38.2 over here. That's because we took big dividends right here. I did a video on this. If you haven't seen it, go watch it out on YouTube. But you could put money in here. This would be a good place to put some. And we anticipate that B drive coming up, going into the B drive right here. This is B1. Oh, thank you. My sweet little wife is bringing me some breakfast. All right, so that's what we're looking at here. So what did we do here? How come we bought this? That was a stupid place to buy in. I don't know what that's all about. Why did that go in there? You know what? I wonder if... No, I don't know why that's there. Get out of it. Why would you buy that? Oh, it was a B2. That's why. We put a little on a B2. That's weird. Oh, well, it's there. B1, Little B2 was way up there. You missed it, land. B2 is way down here. What the heck you buying up there for? I don't know. Must have been a demonstration. Let's go leave it that one. Okay, here we go. This is our long position. That's a little bit better. So we're at break even. We're looking at this one coming in. There we go. This thing's getting ready to. This is an A2. It's still an A2. Right in here. This is all A2. It didn't break the blue lights. Still coming down. So we're still good. We could buy right there. What is this? Super microcomputer. I think that there's I think there's a dividend version of that. So A2, A1, A2. It didn't break the blue lights. It's getting ready to rally again. I don't think that would be a bad buy right there. You could probably buy right there. We got our long call right here. We could sell a put right here in anticipation of just collecting some premium. You want to do that? Let's get rid of these long positions just because they're pain in the hiney. Let's just get rid of them. Close out our position. Close the position on the market. Okay. So get rid of those. And let's come in here and put in an option just for fun. We'll just come in here and we'll sell 45 days. We're going to sell a put down in here. It's $239. Oh, look, they're $38. We're trading at $39. That's good. That's 17, 35, $5,000. Let's put in 3 of them. And we'll just go ahead and see if it'll let us market into that. I didn't even check my table. That's good. All right. So we just sold a couple of those. I think the market's going to go. So I'm already long right here. How many have we got? We got 20 long. And so we just sold 3 more to pick up 3 more. So we'll be okay. That'll be fun right there. So we'll sell that. And if it doesn't come down and close, what's the game we're playing? This is a carnival game. So the carnival game that we just put on there is it's got to hit that purple line underneath that red line. If it hits the purple line underneath the red line, then they'll give us 300 shares of Super Micro, which would be fine right there. We wouldn't mind that at all. Okay. But if it doesn't, if it takes off and goes like we think it's going to do right here, well, it's just going to give us the consolation prize, right? We get the little rubber snake instead of getting the big panda, which is $708. Can't complain about that little rubber snake. That's a nice little rubber snake. All right. So $708. That's what we'll get if it stays above there. If it hits the purple line above the red line, we get $708. If it hits the purple line underneath the red line, we get 300 shares of Super Micro. All right, AT&T. That's a win-win situation. Look at AT&T. Wow, why do we have AT&T in here? Is it a 100%er? No, it's not actually part of the 100% club. I don't think it did. I might have. Look at how this thing's crawling. It's actually there because it's got such a big, I think I put it in there. I don't know. Maybe it is part of the 100% club. I'd have to go double check because it's got such a big dividend. And it's one of the largest dividend stocks in the stock market. But when you compare it to the ETFs that do a dividend, it's nothing. It's like piddly amounts. So I use this as a nice comparison. But look at it going through that triangle formation. It's really struggling. Can't decide what it wants to do. Toast. All right, Toast is going into it. Broke the blue lights. I told you it would. You said it's never going to break those blue lights, Land. It never will. Yes, it will. Every single one of them will. I guarantee you. We're going into a B1 right here. All right, so this is the B1, and we want to see it come back a little more. I want to see it hit that 38.2, so we can at least get 25 grand in there, right? That would be nice. If we could put 25 grand in at 38.2, we'd put another 50, 75 in if it hit 61.8. Anyway, that's what we're looking for. There you go. Toast Targa. Oh, look at that. Popping right down there. Higher lows and higher highs, higher highs. We're coming into this little, it looks like it wants to turn around. Now, remember, Targa was a 100%er. It made 100% last year. You can see that thing really made a nice move all the way up through there. Boom, 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 big mountains. Then I get a little big L ABC coming down off the top, and it looks like it wants to turn around and start to go back up. It's probably if we counted it out, it'd be something like it looks like an X4SA1 or something. I don't know. We're going to just call this A1 right down in here for now. I didn't really count it, so just take that with a grain of salt. But that looks like it wants to break and go. You could say this is your A1 back here, Lan, but I don't know. It looks like a good spot to buy, though. Well, let's at least put an option on this thing. Do you think we can get an option? Let's look at the come out 199 days. Nothing. Ooh, 100 days? Nothing. Doggone it. I hate it when you get markets that don't have any options on them. Well, we can't put an option on it. All right. Let's come in here and buy 100 shares. That's $16,000. I don't want to put $16,000 into this rotten market. Let's put $5,000 in there. That's 31 shares. We'll put 30 shares. All right. Put our stop in there. We'll just go down here. All right. Let's let it ride. There you go. Let's go into Tesla. Oh, Tesla. Tesla. Look at that. Drive 1, drive 2. Let's get rid of all these drawings. Can't really see. Well, it broke the blue light. So however many drives that was, it broke the blue lights. Yeah. The question is, are we going to get the opportunity to put in more shares? Because if it just takes off and goes to the moon, come on, Tesla, come back here. I want to put some more in there. I got a whole bunch of Tesla. I gave you guys recommendations to buy Tesla clear back here. Did any of you do it? I did. I bought a whole bunch of Tesla there and here, both. I got a lot of Tesla, but I bought it over here. And I've been getting really juicy dividends off of it. Now, look at this. Tesla over on this one. I don't pay so much attention to this one because this isn't really it's not really a trend trading market. It's just a reflection of the account, of our options trading account. So these guys trade options for us. That's what they really do. They just trade options for us. And that thing came in, but it broke. It's ready to go. So but that's relying on this one going, that you can see. But this will flush. This will flush out right here if Tesla flushes. So if Tesla comes back down into this region here and gives us an opportunity to buy in down here, then Tesla will flush as well. And so don't be anxious to get into Tesla, Tesla, the dividend version, just because it looks like it's got all the perfect setup for a rise. Because this looks like a perfect setup for a new rise, right? Going into the B drive, but it's all reliant on what happens over here. And this is the one you want to watch. Don't ever get into this market based on the technicals of this market. You can look at them and we count them and we measure them and we look at them and we line them all out and it's fun to watch. But this market is 100% reliant on this market. So if this market's getting ready to pull back, looks like right in here, which it possibly could, but it might not, you never know. But we would like to see it come back into 38.2. That's where we want to be a buyer. We want to buy down in here, Elon. Come on, man. We might not get our opportunity. So you might have to make that decision. If it starts to go and you want to get some in, you're going to have to put it in over here. This market might take off and go to the moon. All right, it is what it is. Okay, United Airline. Whew, there we go. Let's get rid of all of our drawings. So let's just go and see. This is perfect setup, just like right out of the manual. X3SA1, A2, A3, fail. Is that A3 fail? I guess it is. Because we went into a B1. Okay, let's get rid of all this. Look at it go. Oh, we already have some shares. It's getting ready to go again. Let's bring our stop up here a little ways. Ooh, what do you want to do? What do you want to do? Let's see. Let's just see. Let's put in a few more shares. I don't want to move it too high. We'll go into 50. How's that? Go a little bit. All right. So there. Oh, we got to. If we're gonna do that, we got to change our. Let's delete that. Trade 50. That's no good. Let's just type it in. 50. Stop. There we go. All right. VRT. Oh my goodness sakes. These markets are unbelievable. Okay, there's your A1, A2, A2.53, but we got to get it to break those blue lights and come back down and give us an opportunity to get in. Wow, what a beautiful market. VRT. I wonder if it has options. Let's go out to 100. Ooh, we could even trade options on this one. That's exciting. Let's buy a call option when it hits 38.2 or 50. When it gets down in here, we'll buy a call option on it. Otherwise, we have to sit on our hands because don't buy high and sell higher. That's a hard strategy. Not that it can't work for you. Certainly can if you're good at it, but I'm not good at it, so I don't do it. There we go. A2, A15 to A3. Look at that. Look at that beautiful market. Wow. That's definitely an A4. It's definitely an A4. Definitely an A4. Okay. It is what it is. Hasn't broke the blue lights yet, but it will. I promise you. All right, that's it. That's it. That's all I got for you for class. I do have a funny thing for you if you want to wait around for it. I'm going to go look at the SPY because Johnny wanted to look at the SPY. There you go, Johnny. You can read it just as easily as I can. You know as much as I do now. I taught you everything I know. There we go. Man, what a beautiful break. Problem is, it didn't come back, did it? So there's our A1. That's it. Let's do it this way. Let's do it this way. Get rid of that for now. Delete. Delete all notes. Let's just drag our little mountains. Mountain 1, Mountain 2, Mountain 3. Break. Ah! A1, A2, A3. No, A1, A2, A3. That's the way we got to see down in the valley. Just remember me singing this beautiful song for you. Is your A1 down in the valley? That gets screwed up sometimes, though. This is A2. This is A3. Down in the valley. Okay, A1, A2, A3. And then we broke. And that's going into B1 right now. It's going to do it today. Today is going to be B1 because it's going to break that blue light today. I think it could pull back and close below and not break it. But I think the blue lights break even if all it has to do is just hit it. Even if it closes below it, it'll still cross. It'll still flip. So that's B1. Today is a buy on the B1 on the S&P. You want to buy the S&P 500? Today would be a great day to do it. You know what we could do? We could come in here and we could say, I would really like to have some S&P 500. So I'm going to come in here and I am going to come down here and I'm going to say, I'm going to put in here 45 days and I'm going to say sell a put down here at 38.2 because I would really love to have some S&P 500 at 38.2. And I'm going to get $375 if they don't do it. I could do 3 of them, but I don't want to do that. When we could do this, we could do one here. We could sell another call. We could sell another put here. How much is that? And we could sell another put here. You could do that just like that. Mark it into that baby. It's going to give it to us? Nope. Not going to give it to us. Now what did it do? What's it waiting for? Edit. It's not going to let us touch it. What's it doing? Going to let us delete them? Nope. Oh, now it did. I would do that one at a time. If it's not going to let me do them all three at the same time, sell a put here. You could even sell a longer output. You could do this. I'm glad it didn't do it for us. We'll come in and we'll sell one of these. See if it'll market into this one at a time. Okay, we sold one. We're going to sell another put right here. $256. Market into that one. Okay, and then this one we could come out a little farther. Go 73 days, and we'll sell a put down here. Get more money. $368 market. Because we think the market's going to rise. So this is saying, well, we'll buy some shares. It didn't like me on that one. Uh-oh. I don't know where it went. Went into La La Land. Huh. That option, there it is. Finally filled. Okay, now what we can do is we can come in here and we can buy a call. We're really getting heavy here. And oh, look, buying power's down to 7. I don't know if we can do we might be in trouble here. I want to buy a call right here. 100 days out. We could do 73 days out. Won't be as expensive. Oh, we got $7,000. 73 days. That might not be enough. Let's go to 100 days. How are we doing here? Not bad. 2,500. Let's do 2 of those. Just at the money. I don't know if we went 1 click in the money. There we go. 28. Let's do that. Market. See if it'll let us have it. Come on, baby. It's taking a long time. Wait. Why is it taking so long? Slow. Oh, well. We'll see. That's what I did. That's what we did. That's where we're at. Does anybody have any questions? Albert's saying, let's look at Caterpillar. Let's go look at Caterpillar. Ooh, we got the same thing happening here. What a beautiful market. Oh, my goodness sakes. Problem is that it didn't pull back far enough. It's like the S&P. It just wants to go. It's on the Trump train. It's not pulling back into our 38.2 where we want it. If it breaks those blue lights, man. That thing wants to go, doesn't it? I want it down here. I want to buy at 38.2. I want to pull back. Come on, you rotten little dog. Well, Albert, that's the best we're going to get out of it. Our target zone would be, this would be our first target right up in here. See if it'll come up and touch that line right there. I don't know. You got another one up even higher up in here. So this is your little profit-taking zone right up in here. If it comes up into this region here, you would want to take your profits. Not all of them, but most of them. So that's your target. Land Turner makes a prediction. Land Turner says he expects, I really wish I would come back a little farther. We should come back to here. But if it doesn't, we have to do our projections. They are what they are. 61.90, that would be it. We would expect it to be right in there around June 27th. Land Turner says the Caterpillar will be somewhere in there in June 27th. All right. See how good of a predictor I am. Well, if you're going to do it, why don't you buy an option? Well, because I can't get my options to buy. Oh, it did. My S&P went through. I've only got $1,700 left. You think we can get one in here for $1,700? Only not enough day. How many days do we need? How many days is that? That's a pretty straight shot. They would have to get the zoomies to do that. Let's see. Where's my count? Bar count. Where are we? Here to here. That's only 24 days. If we double that, 24 to 24 would be 48 days. So we need 48. There's 45. 73. Ugh, look at the rotten. By that call, not enough buying power. 1,800. We're just a little shy. Buying out of the money land. Okay. Buy this one. That's just putting the odds against you, saying you got less chance of making money. Probabilities of making money in that's 46%. Not even half. Probably won't make any money on it. I don't know. Caterpillar burst, we could take some quick. I don't know. We'll do it. Why not? Why not? Let's get her in there. Oh, could not do it. You don't have enough buying power, it says. 17. I thought I did. I thought I had enough buying power. Let's buy this one then. Mark it into that one. It's still not going to let me do it. I'm out of money. Out of the money. Out of money, Albert. I can't get us a long call there. That's Caterpillar. All right, guys. I got funny for you here. For you guys that stuck around, here's the funny. What my friends think I do. What my mom thinks I do. What society thinks I do. What my clients think I do. What I think I do. What I actually do. I know some of you have seen this before. You've seen this before. You spend too much time with land. That's what I can tell you. All right, guys, that's it. That's all I got for you today. I hope you had a good time. And if you did, if you learned anything, go ahead and hit that little thumbs up thing. That's always fun for me to see. I like to see thumbs ups. That's what I like, thumbs ups. So if you guys have any questions, please let me know. And we will catch you tomorrow afternoon, bright and early in the afternoon, 1 o'clock for Power Hour. We're going to do a little day trading. All right. We'll see you then, guys.
All right. That wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh, yeah. Definitely subscribe to Pitt News Magazine. You'll thank us later.